All right, I'm going to give us a little refresher on these basic financial reports. A lot of this should be familiar from your prior accounting courses, but let's refresh our memory a little bit. So what I'm going to do is work through a couple examples of a multi-step income statement and then also a classified balance sheet. So for the first one, we're going to use this data. We are presented information for Artichoke Corporation for the year ended December 31st of 2022. They have provided us information about the revenues earned, the sales revenue. They had some other revenues and gains that they brought in that affected their income. They incurred operating expenses of $105,000. Their cost of goods sold was $462,000. And they also had some other expenses and losses that weren't directly related to normal operations in the amount of $35,000. During the year, they had preferred stock dividends in the amount of $51,000. The company's tax rate was 20%, and it had 65,000 common shares outstanding during the entire year. So remember, the income statement is only reporting the revenues earned during the period and the expenses incurred. Okay, it is not reporting anything related to equity. So when they gave us information about dividends and common shares outstanding, that information is not going to be reported within the income statement. Okay, so there's some little outline information there that we can ignore. The income statement will report the revenues less the expenses to calculate net income. So looking over here, the multi-step income statement first reports the revenues earned in the amount, in this example, of $785,000. They earned those revenues by selling inventory. Right? How do I know that? Well, because the name of their revenue was sales revenue, which indicates it was revenue earned from selling inventory. And I also know that they had sold inventory to earn this revenue because we were provided information about the cost of goods sold. Recall that the cost of goods sold is the cost of the inventory that was sold to earn those revenues. So the multi-step income statement isolates this one expense, cost of goods sold, and subtracts it from the revenues those inventory items were sold, the amount of revenue that those inventory items earned. And if we subtract the cost of goods sold from the revenues they earned, we calculate either a gross profit or loss. Because our revenues were greater than our cost of goods sold, it's a profit. And this gross profit is not the same thing as net income, because gross profit is calculated by subtracting only one expense incurred to earn those revenues. Companies will incur additional expenses beyond the cost of the inventory sold. So gross profit measures how much profit remains after subtracting just the cost of the inventory sold to help the company cover their operating expenses. So from gross profit, we then subtract the operating expenses. Those would be things such as rent expense, salaries and wages expense, utilities expense, those kind of things, costs that they incurred as they were performing their normal day-to-day operations with the goal of earning a profit. Okay. If I subtract the operating expenses from gross profit, it calculates the amount of income earned from normal day-to-day operations. But other things do affect a company's overall profitability beyond just their income from day-to-day operations. There might be other revenues and gains. In this case, $89,500. It could be that they sold some of their equipment and they had a gain, or they had some rental revenue, right? Or some other form of revenue that caused their overall profits to go up. Those other revenues and gains are added to our income from operation. And at the same time, these other expenses and losses, again, same concept. These are not the losses and expenses incurred from normal daily operations. These are decreases to income that were caused by non-routine or non-normal transactions. Okay, so we separate these increases and decreases of profit that are not part of normal operations. We isolate those separately from the income from operations. Right? The ultimate goal is to report how profitable was the company from their normal day-to-day operations, and then report other things that affected their overall profitability. So if we add the other revenues and gains, subtract the other expenses and losses from our income from operations, we calculate a total net income for the company. Then we subtract the income tax expense, which is 20%, just simply multiplying 20% times the amount of income of 272.5. Income tax expense of 54.5. So when we subtract that from our income before taxes, we calculate a final bottom line net income. Again, with this multi-step income statement, we're seeing multiple steps, multiple subtotals, subcalculations along the way to calculating overall net income. Now that we've had a chance to look at a corporate income statement, let's take a look at what a corporate balance sheet would look like. And we call this a classified balance sheet because what we're doing is classifying assets and liabilities into different categories within each. So big picture, the balance sheet is reporting the overall financial position on the last day of the accounting period. It is reporting the total assets the company owns, and it is reporting the liabilities that the company owes, the debt that it owes to others, as well as the owner's equity, or what the value of the company is to the owners. So taking a look at this information over here, they have given us an adjusted trial balance for Artie's Bowling Fund at December 31st of 2022. The adjusted trial balance. This is simply a list of all the accounts that a company has in their general ledger, right, in their accounting system. And over here, they're listing the accounts that have debit balances, and over here, the accounts that have credit balances. Okay. For us, it really doesn't make a huge amount of difference right now, whether they are debits or credits, right? When we're preparing a financial report, we just need the balances of these different accounts. Okay. So preparing a balance sheet, remember, is going to report the assets first. So assets are going to be any resource the company owns that they intend to use to help them to operate. So taking a look over here, what assets exist? Well, buildings, that is an asset. Accounts receivable is an asset. Prepaid insurance is an asset. Cash, equipment, land, those are all assets. These are expenses. Over here, I don't see any assets listed, but what I do see is accumulated depreciation. And if you recall from your prior accounting coursework, this is a contra asset account. This is keeping track of how much we have depreciated on the building. Okay, so these two are tied together. Contra accounts are tied to its related account. So this is a contra asset account. It is tied to the buildings account. When we go to report these assets, we are going to classify them into current assets and non-current assets. And current assets are going to be any assets the company intends to either convert to cash or use during the upcoming accounting period, the upcoming year, to help them earn revenues. Okay. So taking a look over here, my current assets are going to be cash, accounts receivable, prepaid insurance. The other assets, buildings, equipment, and land, those assets the company doesn't intend to use up within the next year, right? Those are what we call long-term assets or property, plant, and equipment. And we intend to hold on to those for this year and for future years to help them earn revenues. So the current assets, this section of the asset section, is going to list assets that we will either use up or convert to cash within the next year. So cash, accounts receivable, and prepaid insurance. Listing those out and totaling them up, total current assets. Then we list our equipment, buildings, land, those assets that we do not intend to hold on to and use within the next year. We intend to hold on to and use them for this year and future years. Okay, we don't intend to use them up right away. So looking down here, we've got our land, our buildings, less its accumulated depreciation, our equipment, less its accumulated depreciation. Okay. Totaling up our property, plant, and equipment, and adding that to our current assets, total assets 286.3. Now we're going to prepare our liabilities and equity section. Liabilities are going to be any amounts or any debt that the company owes to other. Looks like we have accounts payable and notes payable. We also have interest payable, and it looks like that makes up all of our liabilities. I don't see any other liabilities in here. One note down here that we need to pay attention to. This note payable, of the total $96,400, $28,700 of it will be paid next year, right, in the upcoming year. When we are classifying our liabilities, we are classifying them into current and long-term. Current liabilities are going to be liabilities that the company has to pay within the next year. Long-term liabilities are going to be liabilities that aren't due, do not have to be paid until beyond the next year. So when we're listing out our liabilities, we need to report the accounts payable, the current portion of the notes payable, and the interest payable. The current portion of that note payable is $28,700. So our current liabilities, notes payable of $28,700, accounts payable of $11,200, and interest payable of $2,900. Total current liabilities $42,800. The remaining portion of that note payable, right, total note payable of $96,400, of which $28,700 is current. I'm going to subtract the current portion from my notes payable to figure out how much of that liability is long-term. So the remaining portion of that note payable is going to be listed within the long-term liabilities. Total liabilities are $110,500, but we have separated them into their current, has to be paid within the next year, and non-current or long-term, does not have to be paid for beyond the next year. All right, our final section of the balance sheet is going to be owner's equity. And for a non-corporation, they are just going to be reporting an owner's capital account. If we're talking about a corporation, it's a similar concept, except for a corporation, it would be called shareholders' equity or stockholders' equity. But ultimately, the value of the company to the owner's capital for a sole proprietorship or stockholders' equity for a corporation. The value of the owner's capital is going to be the amount of investments which are recorded in owner's capital initially. And then the other things that affect owner's capital during the year are going to be revenues, expenses, and if there were any withdrawals or dividends paid out of equity. In this example, we have owner's capital of $119,300. During the year, as things happened that caused their equity to change, the company earned revenues, they incurred expenses. Those had not been directly recorded into the owner's capital account. we had been tracking those separately in other equity accounts. When we go to report owner's capital on the balance sheet, though, we need to include all things that affected owner's equity during the year. So we're going to combine the balances in these equity accounts. Owner's capital is increased by the amount of revenues, so I'm going to add the 16.5 to my owner's capital. And then I'm going to subtract my expenses. Insurance expense, subtract out depreciation expense, subtract out interest expense. That leaves me with an ending owner's capital of 125.8. If I add my total liabilities to my total owner's capital, I get an ending liabilities and equity of 236.3, which should equal my total assets. The balance sheet is reporting total assets equal total liabilities and owner's equity. Hopefully this helps with the refresh your memory with the concepts of the income statement and the balance sheet. Don't hesitate to reach out with questions.